friends. In this video, we are going to learn something about the financial statements of a company. I have divided this chapter into 3 parts. We will learn the format of financial statements and its contents. Let us start with the financial statements. Financial statements are those statements of a company that depict the financial position and the result of the business activities at the end of the accounting period. We all know that in financial statements, basically we prepare income statement and balance sheet. With the help of income statement, we come to know about the operating performance of the company, whereas with the help of the balance sheet, we come to know about the financial position of the company. Financial statements of a company are also called annual reports, annual accounts, or published accounts. What is exactly included in financial statements as per section 240 of the Companies Act 2013? The first one is the balance sheet. We know it is a statement of assets, liabilities and equity. It shows the financial position of the business by detailing its assets, equity and liabilities. Another name for balance sheet is position statement. Second, we prepare statement of P&L. With the help of this statement, we come to know the result of the business operations during an accounting period. Another name of statement of P&L is income statement. Next is notes to accounts. Very important, because when you prepare balance sheet and statement of P&L, you just get the final value over there. But the details of the items in the balance sheet and the statement of P&L are to be shown in notes to accounts. Next one is cash flow statement. It is prepared as per Accounting Standard 3 revised and it must be published as per requirements of section 240 of the Companies Act 2013. So we have 4 things over here as a part of the annual accounts, that is published accounts. Number 1, balance sheet. 2, statement of P&L. 3, notes to accounts. And 4, cash flow. Now let us go through the format of the balance sheet. This is really very important. Every company is supposed to prepare the balance sheet and the statements in the vertical format. A child needs to learn the format. A child needs to know about its contents. So I have tried to make you learn the format in easy way. This is what is the format of equity and liabilities of the balance sheet. You can see the columns, particulars, note number, the values at the end of the current year and the values at the end of the previous year. Equity and liabilities. You can see that it is basically divided into 4 parts. Shareholders fund, Sampa, non-current liability and current liability. To memorize shareholders funds, what I want you to learn is SRM, Shri Ram. Second is Sampa. Third, non-current liability. For non-current liability, I would like you to remember the word as DOLL, D-O-L-L. We can see that it starts from L, but yes, to memorize it in an easy way, we can have it like D-O-L-L, start with second D, third is O, fourth is L, and again first is L. And in the similar way, for current liabilities also, you can remember the word as TOSS, T-O-S-S. T is the second content, O third, S and S again is fourth and first. So how are we going to memorize this? Equity and liabilities. Basically there are 4 major heads: shareholders funds, Sampa, non-current liability and liability. In shareholders fund, Shri Ram, Sampa in itself is a head and the subhead. Non-current liability, DOLL, and current liabilities, TOSS. In the same way, we have something for assets also. On the asset side, we can see that basically it is classified into 2 categories. The 2 major heads are there: non-current assets and current assets. In non-current assets, we can see the subheads over there. It is FTICI, NDLO. And in current assets, it is CIT, CSO. How are we going to memorize this? Fatafat, Tiki, New Delhi se lo, right? For non-current assets, it is Fatafat, Tiki, New Delhi se lo, and then for current assets, it is CIT, CSO. Okay, so this is how we are going to memorize the format. Now let us see what is all there, like for Shriram, Sampa, Doll, Toss, and then Fatafat, Tiki, New Delhi, Silo, and Seat Kaso. Right? Let us see the contents. You can see there the proper format. Equity and liabilities, shareholders funds. Shriram is nothing but share capital, reserves and surplus, and money received against share warrants, SRM. Sampa is share applications money pending allotment. Doll and Toss, non-current liability, it was Doll, right? D stands for deferred tax liability. O is other long-term liabilities, long-term provisions, and long-term borrowings. This is Doll. But please don't change the order. Order has to be LDOL only. So deferred tax liability, other long-term liabilities, long-term provisions, and long-term borrowings are the subheads of non-current liabilities. In the same way, for current liabilities, I give you the word as TOSS, TOSS. T is trade payables, O other current liabilities, S short-term provisions, and S again is short-term borrowing. Order has to be STOS. On the asset side, for non-current assets, it was Fatafat, Tiki, New Delhi, Selo. So the same thing is over here. Fatafat, that is fixed assets. Tiki, that is tangible assets. Intangible assets, capital work in progress, and intangible assets under development. New Delhi is non-current investments and deferred tax asset. LO is long-term loans, advances, and other non-current assets. In current assets, we can see that it is CIT, CSO, Seat Kaso. So current investments, inventories, trade receivables, cash and cash equivalents, short-term loans, advances, and other current assets. So I have just mentioned over here how to memorize the balance sheet, and then you have to remember the contents also, heads and subheads. Let's start discussing the equity and liabilities. Equity and liabilities, we know, like shareholders funds, Sampa, non-current and current. 4 subheads are there. But in this video, I shall try to cover 2 heads over here, shareholders fund and Sampa. In shareholders funds, it is share capital, reserves and surplus, money received against share warrants. Equity and liabilities, equity is the liability towards the owners, the shareholders, and is termed as shareholders fund. It includes share capital, reserves and surplus, and money received against share warrants. The term liabilities means external liabilities of the company, that is, the liabilities towards outsiders. It is shown as non-current liabilities and current liabilities. In between shareholders funds and non-current liabilities, we have Sampa. Sampa is share application money pending allotment. Let us learn something about shareholders fund. Shareholders fund includes 3 items. Shriram, as I have told you, SRM, share capital, reserves and surplus, and money received against share warrants. Let us learn something about share capital. Share capital means amount received by the company against shares issued for subscription and also shares issued for consideration other than cash. The shares can be issued for cash as well as for consideration other than cash. So whatever the shares have been issued for subscription and also issued for consideration other than cash, that has to be a part of the share capital. And do not forget that share capital will include both, that is equity share capital and preference share capital. Schedule 3 of the Companies Act 2013 requires the balance sheet to disclose authorized capital, issued capital, subscribed capital, called up, paid up. All these details are required by the schedule given in notes to accounts. Let us see the details of these amounts. What is authorized capital? Authorized capital is also better known as nominal capital, registered capital. Authorized capital is nothing but the maximum amount that a company can issue for subscription under each class of share capital. The amount of authorized capital is shown in notes to accounts on share capital for information only. Please remember that it is not added to the liability. This is the maximum capital the company can issue throughout its lifespan. The second is issued capital. Issued capital is that part of authorized capital which the company has issued for subscription up to the date of the balance sheet. We have to remember that the issued capital can be equal to or less than the authorized capital. It can never be more than that. And one more thing, as we have seen for authorized capital, same way issued capital is shown in notes to accounts but will not be added to the liability. Next is subscribed capital. What is subscribed capital? So subscribed capital is that part of the issued capital which has been subscribed by the public. Amount received by the company, whether in cash or in kind, as subscribed capital is shown as share capital on the face value in the balance sheet. Subscribed capital is classified in two heads. The first one is subscribed and fully paid up capital. Shares are shown as subscribed and fully paid up when both the following conditions are met. Which are the two conditions? Number one is the company has called the full nominal face value of the share. This is first condition. If the face value of the share is 10, company must have given a call of 10 rupees. The second condition is the company has received the amount called up. That means if 10 rupee has been called, if 10 rupee has been received, then only the amount will be categorized under this head, that is subscribed and fully paid up capital. Let us see the example. X Limited issued 10,000 equity shares of 10 each. Rupees 10 per share has been called and it has also been paid by all the shareholders. One has to remember over here, it has to be the full nominal value. Nominal value is 10. 10 rupee must have been called and must have been paid by all the shareholders. If you say that ki rupees 8 called, rupees 8 paid, then it will not be shown under this head. So again I repeat, for the amount to be categorized under this head, subscribed and fully paid up capital, it should be fully called, the full face value, and it should be fully received by the company. Subscribed but not fully paid up. Shares are shown as subscribed but not fully paid up under the following two situations. Let us go through one by one. When the company has called the full nominal face value of the share but not received the amount called up. For example, X Limited has issued 30,000 shares of rupees 10 each. Company has called up rupees 10 per share. All money is received by the company except the final call of rupees 2 on 10,000 shares. So these 10,000 shares will be categorized as subscribed but not fully paid up. Second, when the company has not called the full value of the share, example is in front of you now. X Limited issued 10,000 equity shares of 10 each, rupees 8 called up. When it is not fully called up, so we are going to show it as subscribed but not fully paid up. Called up share capital is the next category. Called up capital means such part of the capital which has been called for payment by the company. It is not necessary for the company to call whole face value of the share in one lot. Company can call the amount in installments, the face value in installments. The portion of the face value of the share called by the company during the accounting year is called as called up capital. Say for example, a company has issued 10,000 shares of rupees 10 each, and out of that 7 rupee has been called. So called up capital will be 10,000 into 7, that is 70,000. Paid up share capital. Paid up capital means such aggregate amount of money credited as paid up as is equal to the amount received as paid up in respect of shares issued. Whatever the amount has been called up, and if all the shareholders have paid the amount, or whatever the amount is paid by the shareholders to the company, so that is basically categorized as paid up capital. What is calls in arrears? Calls in arrears is the amount not paid by the shareholders against the amount called up by the company. Whosoever the shareholders are there, not able to pay the money or not willing to pay the money, the amount left out to be received from those shareholders is known as calls in arrears. Where do we show calls in arrears? The calls in arrears is always shown as deduction from subscribed but not fully paid capital. Next term is calls in advance. A company may receive the amount of calls on shares not yet made by the company. It may happen Like some of the shareholders are there, those who just pay us the amount before the company has given a call. So such an amount is termed as calls in advance. Where do we show this in the balance sheet? It will be shown in the balance sheet as other current liabilities under the head current liabilities, along with interest thereon, if any. Next term is share forfeited account. If shareholders fail to pay the amount called on shares, the company can forfeit these shares after the compliance of procedure given in the law. The amount paid by the shareholder on such shares is forfeited and it is added to the subscribed capital at the end. Company has the right, if shareholders are not paying the called up amount, the company has a right to forfeit the shares and forfeit the amount, and it is added to subscribed capital. Reserves and surplus. Reserve surplus is the second head under shareholders fund, share capital, then reserves and surplus. Reserve surplus should be classified as follows. We have 8 amounts over here to be shown. The first one is capital reserves. Second, capital redemption reserve. Third, debenture redemption reserve. Fourth, securities premium reserve. Fifth, revaluation reserve. Sixth, share option outstanding account. Seventh, other reserves restricted to general reserve only as far as class 12 is concerned, and surplus balance in statement of P&L. Either it's a surplus or a deficit, it's a positive balance or a negative balance, it has to be shown over here. Even if because of statement of P&L the overall amount of reserves and surplus is negative, that is supposed to be shown in the balance sheet as a negative amount. This is what I was telling you. Even if statement of P&L has a negative balance, it has to be shown in notes to accounts under the head reserves and surplus as a negative item. And even if the overall balance of reserves and surplus remains negative, it will continue to be shown as negative item under this head. The third part of shareholders fund, that is money received against share warrants. What are share warrants basically? The share warrants are issued to promoters and others as per SEBI guidelines as preferential issue in case of listed companies. AS 20 defines share warrants as financial instruments which give its holders right to acquire shares at a future date. Thus, shares are yet to be allotted against the share warrants, so it is not shown directly as a part of the share capital. Next is share application money pending allotment, SAMPA. Now, when is this amount going to exist? So, if the company has issued shares, but the date of allotment falls after the balance sheet date, in such a case, this particular term will exist, this particular item will exist, that is share application money pending allotment. It can be shown in the manner. Number 1, share application money not exceeding the issued capital and to the extent not refundable is to be disclosed under this line item, that is SAMPA. SAMPA in balance sheet. The second head under equity and liabilities. Okay, this amount has to be equivalent to not refundable. This has to be shown under this head. Second, share application money pending allotment as current liability. The amount of share application money to the extent refundable or where minimum subscription is not met, such amount shall be shown separately under the head other current liabilities of the head current liabilities. So there are 2 ways to show SAMPA. First one, the SAMPA main head has to have the amount equivalent to for which the shares are to be issued. And second, the amount which is refundable, so that amount will be shown under the head current liabilities, subhead other current liabilities. Thank you. I'm sure we have learned something over here. We'll come up in the next video with the next items of the balance sheet, that is non-current liabilities and current liabilities. Make sure you subscribe the channel, Do like and share with your friends also. Thank you once again.